Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and it's a much better looking screen, especially when you look at the broader markets. Because yesterday, while the frontline indices rebounded after Tuesday's brutal sell-off, the broader markets, the mid, the small cap stocks were under pressure, especially where you had earnings cuts and earnings misses. But today, the mid-cap index has bounced back, so it's roaring higher with a gain of about 1.8% and a positive advanced decline ratio. Hi.
Good morning, Reema. You're absolutely right. So post HDFC Bank's last afternoon, there's been a bit of a positive sentiment as far as markets concerned. Yesterday also you saw quite a bit of a recovery. Today we opened down gap down after the kind of weak cues that we see, but it's been a sharp recovery, like you mentioned, from there on. Couple of stocks on the radar, first on the list, L&T as well as Mazagon Dock. Contrasting fortunes over there. Reports indicate, and even our sources from Delhi, Parikshit, tells us that the Defence Ministry actually has found L&T bid non-compliant. Now, this is for a large 70,000 crore submarine deal. So, Mazagon Dock up almost 3.5%. L&T has seen quite a bit of a sell-off today. The other stock in focus, and one from the consumer pack that's doing very well today, is actually Pidilite. Strong volume growth, results largely in line with expectations. The strong volume growth has led to a sharp move of almost 8% for Pidilite today. And on the other hand, the cement pack, remember, quite a few results have already come about. Dalma Bharat, despite a muted set of results, has actually continued its recovery. Yesterday, it opened gap down, saw a sharp recovery, ended in the green. Today, high by over 1%. On the other hand, Nuvoco, however, has slipped in trade. So overall, very mixed trends, but it's been a sharp recovery nevertheless, like you just pointed out, Reema.
Indeed, and in mid-cap IT, we've been talking about Persistent and Coforge, but look at Zensar Tech. That has moved up close to about 12% because in a weak quarter, the companies managed to grow, and they did in Q3 of last year and Q3 of the year before. It was a negative growth in December because of furlough seasonality. But this time, despite the challenges, they managed to grow, and the street is rewarding that. Zensar is the one that we're talking about. So far, the picture across mid-cap IT has been better. Persistent, Coforge, Zensar, all three trading with handsome gains. And today we'll have numbers from Mphasis and Cyient. So the picture on the mid-cap IT will be complete. But let's begin our show with a corporate discussion. Chennai Petroleum reported an operationally weak Q3. Profits are down 97%. EBITDA is down nearly 65% on a year-on-year basis. Margins under pressure. Ed Shankar, Managing Director of Chennai Petro, is now with us on the show. Thank you very much, sir, for joining in. For some details, how were the cracks in Q3 and what is the trend looking like in Q4?
Thank you very much for having me on this show. The cracks, if you look at it sequentially, there has been a huge difference from if you look at the Q3 of 23-24 versus the Q3 of 24-25, there has been a huge fall in the cracks in diesel and also in the MS and SK. Whereas if you look at the sequential benefits, the HSD cracks have improved slightly, whereas the MS and SK also, MS is a slight, it's almost same. Whereas the SK cracks, there's a slight improvement. But what I feel is that if you look at the overall scenario, with comparison of Q3 of last year, the cracks have significantly fallen this quarter.
Okay, sir. So could you give us a sense of how exactly GRMs panned out as far as Q3 was concerned? How do you expect it to pan out for Q4 and the trend that you expect going into FY26?
Yeah. See, actually, Chennai Petroleum Corporation has been going through a turnaround cycle of during the month of August, September, and October. So we have gone through this turnaround cycle, which is actually a natural phenomenon for all the refineries. So we went through this cycle and we have come on stream in mid of October. So if you look at our overall performance with respect to Q3 and Q2, you should appreciate the fact that the operational efficiency and operational efficiency has really gone up, and we have done quite well on the cycle at which the crude processing is concerned. So if you look at the cracks also, there has been a good improvement after November. October, November also, it was very sedate. There was not much of an improvement. However, in the month of December, it has slightly improved. And that is continuing in the month of January also.
Do you want to put a number to it, sir? What would the numbers look like in the subsequent quarter?
Subsequent quarter, it is too early to predict now because we are in the month of January. But as of now, the crude, the cracks have improved. You have seen that the diesel cracks are almost about $12 now. Although the MS cracks are not really very good, but diesel, which constitutes a significant portion of our product mix, it is quite good now. And at this rate, we can look forward to having a better performance in the coming quarter.
Give us an update, sir, on the Kaveri Basin refinery. We understand that you were in talks with banks to raise about 28,000 crore rupees. By when will the refinery go ahead, come on stream? And if you could give us just details of the status.
Yeah, the company, along with Indian Oil Corporation, our parent company, we are going in that CBRPL project on a joint venture basis. So we have approached the market for debt funding. At the same time, we have also approached the government for the equity infusion in the market. So we are looking at the approvals from the statutory bodies to come in, and based on that, we have fixed a timeline of about 30 months from the date of final statutory approvals.
Understood that, sir.
39 months, sorry. Yeah.
Got that. So 39 months is the number that you've given. So once the Kaveri Basin comes on stream, how do you expect that to aid GRMs? You also spoke to us about how GRM has been on a trajectory of recovery, but it continues to trail below the Singapore benchmark. So what is the reason for that, and when can you go at par or beat the benchmark?
First on the GRMs, if you look at how CPCL has fared with respect to our earlier last quarter, you will see that although the Singapore GRM is at $5, we are roughly $4.2, $4.3 we have done. This is to be looked at from the perspective of the turnaround that we have done in the month of October, because around mid only we completed all our shutdowns, and then slowly the production has been ramped up. And now today, if you look at our current production capacity, we are doing more than 100% of the nameplate capacity. So if you look at our GRM with respect to Singapore GRM, which was $5 previous quarter, we were at 4.2 on a core GRM basis, and looking forward that it would be better. Now, if you look at how CBRPL will be focusing on this area, I should tell you that CBRPL, we have a higher petrochemical intensity index. So whatever we are talking about with respect to Chennai Petroleum, this should be close to at least $1 or $2 more it should add to the bottom line on the GRM.
Understood that, sir. Sir, give us a sense of this sourcing mix currently. Is there any impact that you can assess for us in terms of restrictions, if any, that come about on Russian oil? How do you see oil prices move on from here, and how does it impact your operations?
Oil prices, if you look at on a quarter-on-quarter basis, the oil prices have really changed a lot with respect to Q3 of last year. There was almost about $8 to $10 difference on the Brent and Dubai crude, which is considered to be the benchmark. And even if you consider it sequentially with respect to the previous quarter of this financial year, there has been almost a $5 of increase if you look at the decrease in this respect. So what I am trying to bring to your attention is that we as a standing refinery, we need to actually plan our crude in such a way that we have more than 50-60% of the crude which is fixed on term basis. Therefore, there is always the sustained supply available for the crude for the operations. We also focus on some opportunity crudes and also on the spot crude mix. So we were looking at the opportunity crudes of about 20 to 30% in the previous quarter, and now we are looking at the spot market also. So we are looking at the changes that are taking place in the international market with respect to the crude pricing, and accordingly we will take action for that. And as of now, we are quite insulated to what is happening in the coming quarter.
Thank you, sir, for joining in. Look forward to more conversations as the year progresses. Need to get into a short break, but before that, let's dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make informed trading decisions. This week, Nigel interviewed pro trader Rajesh Baheti, Managing Director, Crossseas Capital Services, and asked him about the risk management practices for algo trading.
Well, what kind of risk management practices should retail investors adopt when using algo trading strategies?
So the main thing is, obviously you've got to define what will be your capital risk at risk per trade. That's the fundamental core of any trading principle, that you don't put all your capital at risk at once. Because in trading, because it's a leveraged trade, there is a chance that your entire capital can get wiped out. We've seen options go from 100 to 0. And the lure of the option is that it can also go from 1 to 100 or 10 to 1,000. So that's the reason people get into it. But if you get into it at the wrong time, you don't use your capital wisely, that 100 can also, 1,000 can go to 0. So the first principle of algorithmic trading or any trading would be to allocate smaller bits of capital per strategy to make sure that you're still in the market, irrespective of what the outcome of that particular strategy is. So if you look at most algorithms, they will definitely be having a stop loss, which either a particular investor can set for himself, or these are preset. So in that sense, algorithmic trading actually makes trading safer for you because of these pre-coded stop losses, and beyond a certain point, you will just be stopped out and no more trades will take place. So from that point of view, it's a better risk management tool than pure trading on your gut, because sometimes then you will get emotionally invested in a trade and not book losses when you ideally ought to be booking losses. So from that point of view, I think it's a good risk management tool.
Welcome back to Trading Hour. Well, one particular set of stocks that are in focus, this is on the back of multiple news reports that indicate that Tata Sons may be looking to go ahead and list itself, this on the back of pressure from one of its partners, which is the Shapoorji Pallonji Group. This is still a developing story and there are no confirmations yet. But on the back of that particular reports that have come about, two stocks especially are in focus. The first one is Tata Chemical that you can see on your screen. The stock is up almost 1.3%. And the other stock, which is now trading near the day's highest point, is Tata Motors. And that stock too is in focus. The expectation is that these stocks which hold stake in Tata Sons could see some value unlocking come about. But we'll now move on and shift focus to the commodity space. Manisha joins in, and today we are focusing on soft commodities.
Well, yes, we are. 2024 was a stronger year for many of these soft commodities, where we saw multi-year highs in sugar, all-time highs in cocoa and coffee. And that in some sense seems to be spilling over into 2025 as well, especially when it comes to the coffee prices. Arabica prices are now past $3.35 a pound. And this is a record closing that we saw into the markets yesterday. Well, the supply concerns in top producers has been a problematic thing. Brazil is the top producer, and we are looking at adverse weather there. Actually, the latest numbers that have been coming out of Brazil suggest that for 2024, the crop is down by 1.6% to almost 54.2 million bags. This, in turn, would continue to be supportive for prices going forward from here. But within softs, coffee is not just the only thing. Oilseed prices have been rising as well, and soybean futures overnight surged to a 6-month highs. Crop concerns in South America, a decline in dollar index, and of course, absence of any immediate tariffs led to prices gaining back yet again. So that is exactly what we are seeing. Actually, when you look at 2025, some of these soft commodities actually seem to be doing quite well. Coffee, for one, is up 3% in this year already. Soybean price is almost 7% of gains. So is the case with rice as well. Rapeseed price is up 4%, and corn also has gained up by 6%. So as you can see, inflation for many of these food commodities just about continues.
Okay, thank you very much for that. We will slip into a very short break on that note. On the other side, we'll talk technicals. We'll invite Vishal Malkan on the show.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It it is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Welcome back to Trading Hour. Well, within the cable and wireless space, we've seen three large companies come out with their numbers. The first one was Havells. You saw KEI come out with results after that, and we saw Polycab come out with its results yesterday. Post that, Polycab, which saw a sharp fall yesterday, has recovered quite sharply today. But look at KEI Industries. You know, it's an outperformer within that particular space in terms of top-line growth. And that stock today is up almost 10%. Now is a good time to speak to Vishal Malkan from malkansview.com, who joins in for a quick technical check on the market. Good morning, Vishal. Thank you so much for joining us. First up, what do you make of the rebound that we've seen in the market? It continues to remain very choppy. What is your view on the Nifty and the Bank Nifty?
Yeah, good morning. I think Nifty has been trying to find its feet around 23,100, 200. And the most important thing what happened is 22nd January, which is yesterday, it made a new low and closed higher, which forms a key reversal pattern on the daily chart on Nifty, which also happens to be an important date as per time cycles. So time and price, when they meet, there is a major reversal happening. So I think there's a kind of a medium-term bottom, an intermediate bottom in place, and we can look at a rally towards 23,500 to 700 in the next few trading sessions.
What about stocks? Are there any stocks where you do see a lot of upside?
Yes, the first stock which I'd go with is Concor, which is finding like a higher bottom at 770 levels. Bullish patterns on daily, momentum indicators at support. So I look at a buy with a stop of 760 for targets of 795 and 810. And the second one would be Indian Hotels, which is again finding double bottom at the levels of 755. And I'll go with a buy on that with a stop of 755 for targets of 790 and 820 in the next few trading sessions.
Okay, thank you so much, Vishal, for joining us, giving us a view on the markets as well as stock-specific action. Time now for a short break. Persistent Systems, Vineet Teredesai joins us on the other side to discuss their Q3 performance and the way forward.
Welcome back. All the EMS companies are bouncing back after the drubbing that they got earlier. So Dixon is higher by 4%. Amber is leading with a double-digit up move. Strength seen in Keynes. It's moving up on pretty large volumes. PG Electroplast is another good mover. But these are stocks which have fallen about 10, 15, 20% since the beginning of the year. And today you are seeing a rebound. The other pocket of strength is IT, and especially mid-cap IT. So, of course, we spoke about Coforge, and Coforge, you should pull up a one-year chart. When they announced the Cigniti acquisition, there were a lot of concerns on the street. The stock had actually declined post the acquisition. It went down to levels, there you have it, 4,300. But once the company, integrated it and the numbers started to show, the management talk was upbeat, we've seen a one-way rally in Coforge, and in the last 1 year, it's up, 50-odd%. But outside of that, even the other IT companies, so Cigniti, of course, is also higher in trade. Redington has moved up close to about 13-14% this month, so it's outclassed many of the other peers. And Wipro in the large cap IT pack is up and about. Indus Towers reports numbers today, and the stock is quite excited ahead of that. Indus Towers numbers will be closely watched. Tata Communication, on the other hand, is a bit subdued in trade. But let's talk about IT, because we've got the management of Persistent joining us in just moments from now. So what's happening is that investors are backing IT companies where there is growth despite high valuations. So all the IT companies' numbers which are out so far, we've pulled up the constant currency revenue growth on a quarter-on-quarter basis. Right on top is Coforge and the other one is Persistent. But if you strip that out, the growth rate for the rest of the IT pack has been fairly lackluster. For Wipro, it was flat. For TCS, it was no growth. HCL Tech, backed by seasonality, had a growth of about 3.8%. So it's Coforge and Coforge and Persistent, which are the big outperformers in the large cap IT stock, continue to deliver and investors continue to back them. In fact, these are stocks which are up close to about 50% in the last 1 year. Coforge is up 80% in the last 3 years, while Persistent has moved up 187% in the last 3 years. And this is despite higher valuations. So Persistent is trading at 50 times FY26 PE and 40 times FY27 PE. But Coforge is trading at 45 times FY26 PE and 37 times. So despite very expensive valuation, a fantastic run-up in the stock, like Persistent, as we said, is up 187% in the last 3 years. Investors continue to back them. And it's not just the performance over the last couple of quarters, right? Even the future, because Persistent is now talking about, reiterating the $2 billion revenue growth forecast by FY27. They've now introduced a $5 billion revenue growth guidance by FY31. Coforge is also very confident about sustained robust growth. So the prospects also for these companies are very strong.
And the results of Coforge, the results of Persistent, both of them, what they've done is, they've taken up the entire mid-cap IT pack. So look at names like Cyient, which was an underperformer till just a couple of days ago. Nugent Software, something that you mentioned. So overall, what's actually transpired is that the strong results of Persistent has ensured that the entire mid-cap IT pack today is doing very well. In fact, speaking about Persistent, we now have the company's CFO, Vinit Desai, to discuss their Q3 numbers. Let's get straight away to the new billion-dollar revenue aspiration by FY31 that you have set. Can you share the blueprint to achieve this particular goal?
See, when 5 years back, when Sandeep joined, initially, the company had set up a target of $1 billion. We achieved that in 2023. Then we set up a target of $2 billion to be reached by FY27. If you look at it, looks to be pretty much on track. But as we get ready, we have to start thinking about how can we make this even more better and set our new target for $5 billion by FY31. And there are multiple pillars on it. So if you look at our verticals now, all the verticals are on a run rate of $100 million per quarter. So typically, if you sort of annualize them, they are a $400 million. All of these verticals have a potential to grow up to $1 billion. Now, if you look within those verticals, there are sub-verticals. Taking an example of healthcare and life sciences, we have scientific instruments, medical devices, clinical research, diagnostic services, pharmaceutical companies, payers. If you look at the banking financial services, you have banking financial insurance put together. So within these, there are sub-verticals. So basically, we believe that as we focus now, these sub-verticals itself have a potential to grow and become like a $250 million sort of a sub-verticals itself. So that's our first strategy that we are trying to work on. The second one, obviously, is the Gen AI part of it. This is going to be a wave. If you look at in the past, some of our bigger peers, they got an advantage of a significant growth during certain waves. Initially, you can call it the Y2K, then the offshoring, then the digital wave. All these put together in that wave, the companies who had that unique advantage have been able to take an advantage of it and able to consolidate and grow that. So we do believe Gen AI potential could probably be that way for Persistent to get into that fast growth phase. So that's the second part of it. The third part is going to be a completely non-linearity of revenue that can come in as Gen AI takes the main stage. We will get into more of outcome-based pricing, success-based pricing, license-based pricing. So multiple new models will come out over a period of time, and that can give an exponential growth in terms of revenue, and that can help us in terms of getting to that target. And last not the least, obviously, as you go on this journey, there will be certain capability-based tuck-in acquisitions you may do. For us, North America is the biggest market. Europe, if we get something good, in terms of which can allow us to expand our current market share from 8-9% to around 12-15% by that time. That can be another good opportunity for us. So these are multiple sort of foundation players. Obviously, we have to do a lot of work on it, but this is at least from a thinking perspective, mindset perspective, these are the pillars on which we have come to that 5 billion sort of a target by FY31.
Got that. Now, when revenues hit $5 billion in terms of an annual run rate, the operating leverage will be massive. Plus, we're talking about generative AI, outcome-driven pricing. What can margins look like? What is the potential for margin expansion?
So again, margin today, if you look at it, we are right now at 14.9. We are anticipating that we'll end the full year at 14.5. Our aspiration is to get 200 to 300 basis point improvement by FY27. So our hope is if the AI-led revolution helps us in terms of getting that growth, you'll see the revenue per employee significantly going up, but the cost per employee not necessarily growing up. As a result of that, you will see the margins expansion. At this point of time, it will be too early to call it out where that will be, but definitely it should be better than what our 16 to 17% FY27 target is. So that's where we'll land at.
Okay, let's get to the near term, right? How is Q4 shaping up? Can it be as good as Q3? And what about FY26? A lot of companies have expressed confidence that FY26 can be better than FY25. Where do you stand?
So see, again, at this point of time, all our three verticals have started now firing. Our high-tech vertical, which was a little bit of a laggard, that has also sort of shown growth both on quarter-on-quarter as well as year-on-year. Healthcare has been doing extremely well for us. Banking financial services vertical has also started growing consistently for the last 2 quarters. Again, look at it, we have grown sequentially for 19 quarters. There was a period of post-COVID whereby everybody grew. We did well at that point of time. Last 2 years have been a period of uncertainty. Still, we have grown significantly in this period of time. So at this point of time, looking at what we have done in the last 3 quarters, looking at our order book position at this point of time, we are pretty much confident that the Q4 will be pretty good. I don't want to name, we don't give any forward-looking guidance, but it should be good and pretty much on the same lines as what you are seeing. The momentum should continue. On margins, we had said we'll get to 14.5 in FY25. So 14% was H1. We have come to 14.9. We should do somewhere in the 15% plus to get to that 14.5. And that's what, at this point of time, our confidence tells. Now, as you get into FY26, see, there are a lot of new equations changing. At this point of time, the order book is giving us a comfort that we should be able to grow pretty much on the same lines. That's what the aspiration, at least with our initial planning exercise. We just concluded our what we call as an annual exercise, what is called as a huddle, whereby we get 400 people across the board, lay down the foundation about what your short-term future looks like and what is the plan for FY26. The initial numbers are at least very encouraging. Now we have to go through a filtering exercise and see where we want to land. But I'm pretty much confident. Obviously, there are certain external headwinds which nobody knows. And as they come, we'll see what needs to be done about that.
Okay. And how much will generative AI contribute to your $5 billion goal? Can we put some numbers to it? What are the sizes of the generative AI deals? What percentage of your deal wins are linked to generative AI now? And more importantly, are customers asking you to pass on the productivity benefits linked to generative AI?
So see, generative AI has become like a hygiene factor now. In every deal that we go to a customer, basically what is the unique factor that is allowing us to sort of, win the deals or making us differentiated from the other players is going to be your Gen AI solution. So our SASVA platform that we have put in is one of the very unique one in a very advanced stage. If you look at one of the large hyperscaler who was in CEO who was in India, he did out of the many AI solutions every company has, he called out Persistence Contract Assist AI solution, and which has been collaborated with their AI platform, and we have been able to now take it to the customer. So today, if you look at it, it's a basic hygiene factor. Everybody is looking at efficiency, and that's the winning factor. I don't think so at this point of time, the customer is looking at to say how much of this benefit and you can pass on to me. The customer is more interested in saying, if I'm spending $100 today, can you do it at $80? And that itself is an indirect benefit that is getting passed on to us. How quickly can you do it is the premium that you get on it. Eventually, everybody will catch up and we'll see. But as our belief is, today it's an efficiency phase. Once the market sort of improves, it will be on the shift will happen in terms of saying how fast can you take my how fast can you take my market strategy, and that's where the second wave will start, and people will be right now interested in grabbing the market share rather than looking at the productivity benefits coming onto them.
Thank you very much for that, Vineet. What a mover Persistent Systems has been over the last couple of years. Best performing IT stock. Get into a break. On the other side, we'll discuss market fundamentals. Varun Lochab from HDFC Securities joins us next.
Welcome back to Trading Hour. Well, Varun Lochab from HDFC Security joins us now to discuss market fundamentals and his top sectoral picks. Welcome, Varun. Thank you so much for joining us. First up, going into Q3, what were expectations, especially from the IT pack? Most of the results have come about. Mid-cap IT seems to have beat. What is your view as far as the entire IT space is concerned?
So IT space, we are overall, neutral in our model portfolio. I think the current context of domestic slowdown, IT looks like a good place to be in, at least in the first 6 months. But we believe valuations have already run up quite a bit in last 12 months, and therefore the absolute upsides from here on are not going to be, very high if I look at the entire year. So probably sometime during the middle of the year, one should switch back from IT to more domestic cyclicals like banks and consumer, especially on the discretionary side. So that's our overall view. We are, we continue to like some of the, mid-cap ideas and large-cap ideas in IT, but we are selective and slightly more valuation conscious.
Do you want to tell us about your mid-cap IT day? Because today is a full mid-cap IT day. Even Cyient and Emphasis are seeing buying ahead of their numbers later.
Yeah, so in mid-cap IT, our preferred picks, Persistent has been one of our top house picks for quite a few years now, and our analyst is still bullish on that. We have a positive rating on Persistent. Then in terms of Zensar and Mastech are the other two stocks among the mid to small cap IT where we are positive. And among the large caps, TCS is our preferred pick. So that's the overall sort of view on IT.
Understood that. Are you penciling in a strong recovery, especially from US BFSI space?
So BFSI is obviously seeing, improvement across the board. All management commentaries have hinted towards that. But so there is a overall demand improvement expected in FY26, but the extent of improvement is still not more than 2 to 3%. So a 4% dollar growth will go to 6 to 7% at an aggregate level. Now, obviously, company specific is going to be different. So there is an acceleration led by BFSI and bottoming out in other verticals. But the extent of acceleration, we believe, is more or less also captured in the estimates by everyone. So unless there is a surprise on those estimates, the further upsides on stocks may be fairly limited. But in the current context of the market, they are a good place to be in from a relative perspective.
Right. Right. Varun, the other set of stocks or the other sector that we want to discuss is actually the FMCG space. HUL has continued to disappoint investors, but on the other hand, some signs of recovery coming in as far as Pidilite is concerned. Where do you stand in FMCG? Which are your preferred picks and which are the ones that you will continue to avoid?
So again, overall FMCG, we are slightly underweight in our model portfolio. But if you look at, again, we are being very selective out there. There is a slowdown for sure, at least as far as urban FMCG demand goes. And it's a mix of multiple things. One is high inflation, which is impacting the urban mass and the urban poor. And also, typically for a large FMCG incumbent players, there is a quick commerce sort of a negative impact because of fragmentation of demand. So I think on FMCG, we are overall, I would say, mildly negative, with very few stock-specific ideas like, we continue to like Marico in the FMCG space. Among the mid caps, we like Jyoti Labs. In the FMCG space, large cap, actually, we don't have much upside in either ITC or HUL. So we don't own them much in our model portfolios. So it's more mid cap, Marico, Jyoti, and to an extent Dabur, where we see some upside over a 12-month period. But again, it will take another 1 or 2 quarters for things to stabilize in terms of demand, and then from there on, you should see slightly better growth in second half of this calendar year.
In discretionary demand, I mean, actually more than that, if you could just tell us incrementally, where has your view changed in the last 1 or 2 months? Because some of these calls you've been holding on to for a while. Spot some trends for us, some changes that you've made in your thought process.
So, our thought process is that into this weakness, which has been there in the last couple of months and which will probably continue in the first half of this calendar year, we want to buy more on the domestic cyclicals, which is essentially banks and consumer discretionary. So these are the 2 areas where we have been adding weights through the stock price declines. So banks, again, from a valuation perspective, are starting to look attractive. I think it will again take another 1 or 2 quarters for things to stabilize on the loan growth side and on the credit cost side before you start to see uptake. But they are starting to look attractive from a 12 to 18 month point of view. Similarly, consumer, we believe both will bottom out in first half, but incrementally we are adding more positions in consumer discretionary, things like apparel, QSR, select consumer durables, as we expect second half to be better in this calendar year. And even some of the capex or the infra investment plays, given there has been a decent correction in some of those names as well. We believe again capex will pick up in the next financial year, and therefore we are adding. So we are adding domestic cyclicals in this weakness.
Understood that. Thank you so much, Varun, for joining us. A slightly shorter conversation today, but we'll chat with you once again soon to get your thoughts on the channel once again. Time now for a short break. We'll get you more on the markets on the other side.
Welcome back. We're getting lots of important voices from Davos, and Shireen, who is at the World Economic Forum, caught up with Bain & Company's CEO and worldwide managing partner. Listen in to excerpts from that conversation.
What a post-global world means in terms of opportunities. Here over the last few years, especially post-pandemic, everyone's been talking about reshoring, friendshoring, supply chain resilience and diversification. What will that now lead to? We've seen some of that happen already, but what will you expect on that front?
Yeah, so this is going to happen, and companies need to think about it. And you highlight some individual questions on topical points. The way we think about it is, as companies, you need to think of your portfolio strategy from a geopolitical point of view. Companies have learned in the past to think about their portfolio strategy in products, in markets, customer segments. Nowadays, you have to think about your portfolio strategy also from a geopolitical lens. Where I'm going to play, where I'm not going to play, where is it worth, where isn't it worth to play? And I think also for countries like India, for instance, what role can I play and should I play into that post-global world? And how do I take that realignment as an opportunity so that I can support my industrial base, my companies in my country, in order to tap into the opportunities that the post-global world will present?
Mm-hmm. So let's talk about India then in specific. Where do you believe India finds itself placed to take advantage of some of the opportunities that you spoke of in more generally and more specifically as far as Bain is concerned? It's also the country that is home to the largest talent base for you outside of the home office. So on both fronts, generally as well as specifically, what does India look like?
Yeah. I mean, India looks great. Like, if you want to be in a position where you still have favorable demographics in the world, where you have an economy that's growing, structurally above 5%, and where you can tap into the opportunities of a post-global world more than almost any nation in the world, I think every country would sign up to that portfolio of opportunities that India is sitting on. And so in that sense, I think it's also good for India then to say, now how do we put ourselves on high alert around the opportunities so that we tap into the opportunities of AI, enable the energy transition, in the energy availability, build the infrastructure to support our companies in the AI wave. And I think that is also something that we want to do together with our talent. As you say, after the US, it's our biggest talent pool. You know, our consulting staff, a capability center, our support staff. And what we want to ensure is that we will bring our consulting staff and our capability centers towards the future, enabling themselves to be centers of excellence in an AI world. And I think that will present great opportunities, not just for us, but also for our India teams as we look into the future. A great economy, a great country to be part of, to support the growth of the companies there, and great opportunities for all the talent that we have in the Indian market.
Well, Christoph, you've also very closely been looking at M&A at Bain and looking at private equity at Bain as well. So, you know, from a 2025 perspective, what's the expectation, especially when we talk about AI? Do you believe that's going to lead to M&A and consolidation? Also private equity, where is the money going to be headed?
Yeah, so there's two trends there. On the corporate side, there's going to be M&A. And we will see an acceleration of M&A coming out of this cycle. Because if you would put a pause in 19 and look into 25, it's actually on certain dimensions more normal again, coming out of the big cycles of COVID. And so we will see a resurgence of M&A. I think we see it every day happening now. On the private equity side, private equity has gone through a similar cycle as the overall economy, with a peak and a slowdown. But if we look into a long-term trend, making abstraction again of the COVID period, we see that 2024 was already a good year of growth again for the private equity. And we think that the industry is in a healthy base to continue that underlying trend line that we saw before COVID. And corporate deal making will be great, because corporate deal making is typically a great exit route for private equity firms. And then the stock markets are healthy, and IPOs are also a healthy exit route. And when the exit routes are good for private equity, we see private equity thrive.
Well, a very interesting conversation there, but at the bottom of your screen, just a few minutes ago, you saw a flash come about regarding HUDCO, and that particular company appears to have gone ahead and upgraded its loan growth guidance. We'll get you more on that particular development in a while. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.